Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'm going to interject my financial opinions as we go through it together. It's generally related to three different topics: wealth building, commodities, and or financial topics. So we're going to dive right in there, take a look, see what people are sharing. If you want to follow me, it's at Funny_Finance. And if you want to join our community, finding-value.com, that's where I go over everything. All my opinions I share pretty freely. I look for individual companies with good upside potential, great leverage to this commodity bull market that we are in. So starting with Hedgehog Trader, we've got gold miners greater than 40x upside for GDXJ. And let's see what Formula Stocks here has written here. So I'm going to show this thread. It says the 100-year ratio cycle in mine developer gold miners will outperform gold next 50 odd years as gold re-enters a monetary system. An ABC correction lasting 52 years into 2020 compressed miners versus gold. An impulsive wave up started in 2020, ends around perhaps 2068 as gold now in turn reserves again. So the most important chart is gold miners relative to gold in his opinion here. I can move this over just a little bit. It says in miners divided by gold, a 52-year bearish ABC pattern. So what he's talking about is he's using Elliott wave analysis. What he has here is a potential movement where it peaks, comes down, and then peaks again. Now, what I would say is if you were to look at this, and from all the charts that I've seen, which is a gazillion, I would say that interest rates are a driver of this. When interest rates went up from the late uh, like 30s, 40s, interest rates started to come on up. That's what's creating this big arc and movement. And this movement has been non-favorable for gold mining companies. And what he is saying that we are bottoming here and that we're going to work our way on up over the years. And I don't know if this is going to be correct. It is just one person's opinion. And then what he's saying is that the gold miners are going to have a very large outperformance against gold, with gold going higher. So that's what we're seeing, and that's his opinion there using Elliott wave analysis. Coming back to natural gas. So the lower 48 gas production is now 1.2 billion cubic feet per day lower year on year 7-day average. So here we are falling down in production over this August timeframe. Here's Brandon Balo. He says, well, would you look at that? Gold is the top performing asset year to date. I thought it was just a pet rock, a relic. Only a matter of time before hedge fund managers chase relative performance and plow into precious metals. Another thing, when you look at the asset class going back to 2000, we want to look to see where these things are grouped together. What's outperforming and what is underperforming. And you can use these asset classes and how they're performing to tell where you're at in the business cycle. There's a reasoning behind it. So when you look at when gold outperforms, 2010 it outperformed. It outperformed in 2020 and it's outperforming in 2024. What does that mean? And why is it number one during those time frames? We also have commodities outperforming in 2000, also in 2002. We also had very strong commodity and REIT performance in 04, 05, 06. You can see, and 07 here. Commodities were up at the top this entire game here. That is your commodity bull market. That's what a super cycle is. It's not every year. You can see commodities pull back in 2001. That was our 9/11 slowdown, 2001, the tech bubble. So we went in, it was strong. We had a bubble there, like a recession. And then we came back and the housing market pushed us higher with lower dollar. Those are the drivers during that time frame. I think what is coming is similar because if you notice up here, look at what's outperforming here. In 2020, we had gold outperform, commodities was bad. That's your recession. So 2020 is very, well, it could be similar to 2001-ish. Then you can see commodities outperform in 21, 22, and then commodities underperformed in 23. We basically had a slowdown in the market in 2023. Reliquefaction generally comes. That is your gold outperforming because gold hits that reliquefaction just like 2020. And then I think we're going to see potentially an outperformance of commodities come on up. That's my opinion. Obviously, right now the S&P 500 is still doing well, and same with emerging markets. I think emerging markets is going to start to come up. When you have low inflation and a stronger dollar, you're going to see emerging markets stay down here. You can see all the purple is emerging markets here. It's all at the bottom. You're going to start to see emerging markets come up here and be at the top, in my opinion, of what's coming next. That occurred when the dollar dropped. In 2002, we had the dollar drop, which is occurring right now. Then you can see 2003 emerging markets, 2004 emerging markets, 2005 emerging markets. This is when the dollar was falling the entire time. 07, the big crash, it obviously hit emerging markets hard. But then the dollar kept falling all the way to 2011. So we had two huge outperformances. 79% in 2009 for emerging markets in 1 year. These are big outperformance, guys. This is 56% in a year, 35% in a year, 40% in a year, 79% in a year for these emerging markets when the dollar is declining, 32% in 2006 year, and this one here is 26%. Absolute domination in emerging markets when the dollar drops. So I think what we're going to see going forward, and that this is important, is I think emerging markets is going to do this. It's going to crush it. And I think that commodities will do well and gold. Gold's going to stay up here too. But we're going to start to see that for the next however long. We'll have to watch it. Here's Rajat Sani. He says, and I wanted to make a point here. So these guys, a lot of people think like this, and I just want to address it. I'm not trying to change your mind. Just listen to me here real quick. $625,000 home. They put a 20% down payment, $500,000 mortgage. With a 6% interest rate and a 30-year term, you're paying $579,190 in interest. The $625,000 house costs you $1,204,190. This equals to a $3,345 monthly rental payment, plus you pay for maintenance and repairs. Houses cost so much because people can borrow money that's created with a press of a button to buy them. If everyone had to pay cash for their home, prices would drop significantly. Most people think mortgages are designed to help them, but no. I agree with that. But I want to make a comment here about the calculation he did. What he said is actually not a true statement, even though he's a certified financial accountant. He said the $625,000 house cost you $1.204 million. That is actually incorrect because he's comparing dollars in the future to a house price of today. So the house, if I were to say this, it depends on the inflation rate that you have. And money 30 years from now is not the same as money today in terms of purchasing power. I purchased a home. Obviously, my interest rate is 2.75%. The reason I did that, or one of the main reasons, is because I did two things. I thought that my costs of rental income, for rent, not rental income, but my cost of renting a house would go up substantially. I thought it would go up well more than 2.75%. And then I thought the inflation in the future would be greater than 2.75%, the real rate of inflation. Your money and your purchasing power is declining at probably 10% a year. 10% is what I think is the true inflation rate when you measure it with the same items over time. it's probably around 8 to 12% per year. If I can lock in a mortgage at 2.75% and I look at money that is 10, 20, 30 years away, that money and its purchasing power that's losing its purchasing power between 8 and 12% a year, that money is not the same money that I'm paying today. So, in my opinion, the loan that they gave me on my house, in this case, the $500,000 mortgage this guy's talking about, is not the same money in the future. I got $500,000 purchasing power mortgage today, and I pay it back with less valuable dollars. I am guessing that a 1.204 million payment over the sum of all of those years could be less of actual purchasing power than the 500 mortgage that you took out. So the mortgage that you paid off with the interest and then the devaluation of the dollar is more than the purchasing power it gave you today. So just keep that in mind. And I know that's kind of hard to understand. But a lot of people just talk like this money that you're paying back, like you're losing something. The value of the dollar is losing purchasing power faster than this 6% interest rate. You're still gaining in purchasing power by doing this. And whenever your dollar is losing its purchasing power at a faster rate than the interest rate, you have that set up. Neil Jacobs says, how do you respond when people say Bitcoin is just a bubble? I would shake their hand and say, you are probably correct. That's what I would say. And that's my response. Lucas says, a blow off top, then a recession, then a generational opportunity in terms of buying. I think if we do get a recession, like great financial crisis recession, I don't think I don't think we're there yet. I think it's going to be some years away. If they lower interest rates, watch what the housing starts do and watch construction employment. If they continue to go up, the recession is going to be further into the future. It's not going to be that close. That's my opinion. And you're going to see a large commodity bull market. So all of those assets that we were looking up, that big table that we were just looking up above, what you're going to see is you're going to see gold, and then you're going to see commodities and emerging markets start to outperform. That's what I think is going to occur. Here's XLE. That is an energy ETF. The energy sector ETF is starting to break out against oil. So we're starting to see an outperformance here and breaking of this. Now, remember that pattern that we always look for. It's that same pattern and breakout here. So I think we're going to see a big move in oil equities here pretty soon. The setup's there. The charts look good. Fed Kashikari says the balance of risks have shifted more towards the labor market and away from the inflation side of our dual mandate. So their dual mandate, the Federal Reserve is supposed to look at inflation, try to hold it at 2%. And then they also look at unemployment. And right now, the risks have shifted more to the labor market, the unemployment numbers, and away from the inflation numbers. Just an FYI. Here's silver production for quarter two. The big boy Fresnillo being number one. KGHM, Vedanta, then Southern Copper, Mag Silver, Glencore. Those are the big boys. Here is the United States dollar DXY tailwind. We can see that we're breaking to the downside. We've got what he calls a bearish evening star going on there. And we're heading on down, and we could see this drop. Then we've got another support level at that $96.7 or 96, 97 index range. And we'll see if we can hold that or if we continue to break lower. A weakening of the dollar is a big deal. The reason it's a big deal is because commodities are priced in dollars. That's another reason why I think emerging markets are going to start to outperform, is because the DXY will start to underperform here. These are all interconnected. When that underperforms or the DXY goes down, you're going to see people prefer other currencies. The dollar breakdown is accelerating today, and he's got another little part for that. Each one of these big breakdowns Emerging, I would look for emerging markets, but this is pretty short term. I'm looking for the bigger, longer term. Like 2002 was a big breakdown. I think that this could potentially be a big breakdown here for the dollar. Junior miners are gapping up on massive volume. We're nearing escape velocity here, and there's that same pattern again where we come down, we come up. We'll probably pause a little bit there, and then we break. So that's looking real good for GDX, GDXJ. Ladies and gentlemen, this is the junior one. So this is GDX that we were looking at here. This is GDXJ. That's also breaking a downtrend line. Looking fantastic here, guys. Absolutely fantastic. We have a little bit of resistance going across here too that we're trying to break out of as well. Crude oil seasonality. I just wanted to bring this up again. This is 30 years seasonality. This was done in 2012. So you can see that we've got strong seasonality all the way up to, I'd say, October timeframe. And then we get a weakening in October. And then we strengthen from February onward. That is the seasonality that we've normally seen in history. Doesn't mean that the markets are going to follow this to the T, but just just be aware of it is what I'll say. Updated 2024. So we've got this 4-year cycle going on here. So 2011, 14, 18, and 2022 were down years. And these were all up years. We're in the first bull phase is what they've got it. 24 and then 25 is the second bull phase. And that's the 4-year cycle that's been going on here. Here's Grady with the S&P 500. He says, been saying the S&P 500 is very late for its 4-year cycle decline. Just like before the expected 4-year cycle decline back in 2020, COVID mess enhanced that decline, but a larger decline back then was very much expected using real cycle analysis. When a larger cycle is very late for the declining phase, the decline could be swift, since it has to perform the declining phase in a much shorter space of time. And when a stock market moves down hard, most markets and sectors get affected as people get margin calls and then often sell what other holdings they have in order to meet those margin requirements. As said for the last 6 to 4 months or so, the stock market could start a deflationary scare, great financial crisis too, at any time now with the systemic risks around. But one must always go by what is actually happening, not what might happen. If it comes, we'll see it in the charts at the service, as did back in 2020 stock market crash. As long as the S&P 500 holds above the blue line below, all is good. Should it close below that line, one should pay attention. There's the line. We're up above it right now. We're looking to see if it closes below it. We're seeing the relative strength weaken potentially over time, and we'll see if it tops out and turns over. Here's this 4-year cycle that we've got at the bottom there, and we could get a potential move lower here, and it's moved to the right of this potential move lower there. So that's what he's got there for the 4-year cycle analysis against the S&P 500. And we should be looking potentially, if we break below the blue line, for potential weakness. Here's Jordan. He says gold stocks versus the S&P 500. It's a ratio chart. It formed a bullish inverse head and shoulders bottoming pattern based on my historical gold stock data going back 100 years. The February 2024 low was an all-time low. So going back 100 years, GDX, the gold and silver, or I should say gold mining companies, ETF, or a proxy for it, has never been this cheap in history going back 100 years. It's an all-time low in 2024. And this is a shoulder, head, shoulder bottoming pattern that maybe we can start to work our way out of. We've got global liquidity is moving up fast. It says do yourself a favor in trading charts and enter this formula. And I did that. I entered that formula. And I am now watching global liquidity, and it is going on up, and it looks like it's breaking to the upside here. That's also could be one of the main drivers of gold and the reason why gold is going up. It's accounting for the liquidity in the system. This liquidity will eventually work its way to oil. And if you look downward, 2024 here is when it broke out. There's going to be a 6 to 18 month lag behind this data and oil price, and potentially even uranium price. That's something you want to look for. And that's what we've got for today, guys. So we're going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you guys like. Mayday coupon code is still active if you're interested. And we'll catch you guys later. This is Finding Value.